As a trader, you have a lot of different choices in terms of charts and time frames that you watch. Our guest today is Marcus Heitkotter. He's here to talk about the types of charts that he likes to use. So Marcus, what is it about charts that you do a little bit differently?
Well, I like to use range bars when I display my charts. You see, when you're displaying charts, you have basically three choices. You can use the time-based chart, like a 5-minute or daily chart or 60-minute chart, where you plot a new bar or candle after a certain amount of time has elapsed, for example, 5 minutes. Now, the second way is to use a volume-based chart. Here would plot a new bar or candle after a certain amount of trades have been taking place. So this means that you're expanding the charts during high trading activity, and you're contracting the charts when there's not a lot going on in the markets. So more and more traders are using these volume-based charts. What I like to do is use volatility-based charts, and these are the so-called range bars.
And what about range bars are different than the other types?
Well, here we are looking at market movement. So we are looking at a predefined range, for example, 2 points. And we are only plotting a new bar if the market moves more than 2 points. So I'm taking the time element out of the chart, and I'm only interested in market movement. So if the market moves a lot, I'm expanding my charts and I'm getting more bars. And if the market does not move, like in the overnight session, I'm getting just fewer bars. Now, range bars have a lot of fantastic advantages.
And talk about those, because I know that finding a good entry or ways to actually recognize patterns is what everybody's trying to do. So how do they help you do that better?
Well, since range bars have a fixed length, you know exactly where the high of the bar will be. Because if you're using a 2-point range bar, the high will be exactly 2 points away from the low. And you know where the low of the bar will be, because it will be exactly 2 points away from the high. Now, by definition, range bars can only close at the high or at the low. And depending on where they close, you know where the next bar will open. Because if they close at the high, the next bar will open 1 tick above the high of the previous bar. And if they close at the low, the next bar will open 1 tick below the low of the bar. Now, if you think about it, you have the 4 variables, open, high, low, close, when you're plotting a bar or candle. Now, with range bars, you know where the high will be, you know where the low will be, you know that the bar will close at the high or at the low, and you know where the next bar will open depending on the close of the previous bar. So this is what I believe gives me an edge in the market.
So are you able to see patterns easier with this type of chart?
Absolutely, because whatever indicator you are using, you will see that you're getting a clearer picture on trends. Because you don't have these tiny bars or these long bars that you have on time-based charts, you're really having an even distribution of bars. And if you haven't traded range bars yet, you should just check it out and see that you get a completely different picture of the market. And as a trader, that's what I'm looking for, a different view on the market that is giving me an edge over other traders.
Marcus, thanks for your time.
Okay, thanks for having me today.
You're watching the MoneyShow.com video network.